Hi, I'm Pattu from freefincal, and in this video, let's talk about Franklin Ultra Short Term Bond Fund. Uh, there's been a lot of credit downgrades and credit defaults, bond defaults in the debt fund space. Uh, Many investors are scared now of investing in debt funds, any kind of debt funds, because they're now waking up to the kind of risks that these are uh, prone to. But in spite of that, many on that's on one side. On the other side, many people are interested in this fund, Franklin India Ultra Short Term Fund. It says super institutional plan, but I don't think that is valid anymore. I think anybody can invest in this fund. There's no issue with respect to that. Um, there is a this fund was what when was it launched? It was launched about almost 12 years ago now, and this is an ultra short term fund, which means that it will invest in bonds of a few months in maturity. But the big problem is that if you look at the portfolio, sorry, I didn't click that. So if you look at the portfolio, it says the average maturity of the bonds is about half a year. That's like 6 months. That's typical. But if you look at the yield to maturity, the yield to maturity is a number that does not mean that that has nothing to do with your expected return. Many people make this mistake. It just tells you the kind of bonds that the fund manager will invest in, whether it's high yielding bonds or low yielding bonds. High yielding bonds means that the credit risk will be high. So the whole idea in the bond space is that if a bond is going to give you 10% or 12% interest, this means that it has to give you that high interest because its repaying capacity is not sound. So this is very important. It's counterintuitive. If the repaying ability of a person is very good, then the interest they will offer will be low. If the repaying ability is not sound or unsure, then the interest that they have to give for borrowing will be high. So when it is going to invest in bonds with a weighted yield to maturity of nearly 10%, this means that it is investing in risky bonds. So the first thing you should understand is that never ever choose debt mutual funds by looking at star ratings, because star ratings cannot factor in credit rating changes or credit risk in debt funds because it happens suddenly. Star ratings can only factor in volatility, which is up and down movements because of the daily demand and supply. The market price will change of the bonds. So never ever look at the 5-star ratings. Never ever buy debt funds looking at past returns. For example, if you look at this performance of this fund, you look at this. This is 8.6%, 8.2%. 9.68%, 9.7%. If you go by this kind of past performance and buy this fund, you are in serious trouble. Let me remind you that. So that is the reason why I do not review debt mutual funds by using rolling returns or rolling risk. Excuse me. The first thing you should do is to go straight to the portfolio tab, and you need to look at these factors which I just talked about. Look at the portfolio here. 40% of it is an AA bond, A and below another almost 40%, A1 plus, which is the highest rating, or AAA, which is the highest rating of another agency. So different agencies have different rating scales. These are the safest guys. The safe guys are here. The safe guys are extremely low. These are the extremely risky bonds. You can see that. You can see it from here. These are not many of these names we wouldn't have even heard of in normal day-to-day life. So that's very dangerous. Somehow, if you look at the performance of this fund, somehow this fund has managed to stay away from credit risks. As far as I know, this fund has not been faced a credit problem. Somehow it has escaped. That does not mean that it is immune to such risks. Investing in this fund is essentially like walking on fire, or walking on a wire, whatever you want to call it. Sooner or later, there will be a credit problem. Sooner or later, the investors will have to suffer a sharp downgrade in the NAV. If you are ready for it, go ahead. Please recognize ultra short term bonds. If you let me see what the AMC says. So if you just copy that down, AMC will tell you. Franklin, incidentally, Franklin AMC is one of the AMCs where in Google search result it ranks pretty high. So it will tell you suitable for, it will tell you the duration. The ideal investment horizon is the recommended investment horizon is 1 month or more. Then here it says the ideal investment horizon is 1 year or more. Please, the recommended horizon is 1 month or more. The ideal horizon is 1 year or more. So, well, so they are very clear. The ideal horizon is 1 year or more. How do you decide the ideal horizon? For any debt fund, you go to the portfolio, and then you look at this. This is the average maturity, about 0.5, 0.6. Multiply it. They have multiplied it by 1 and by 2 and said this is 0.5, so 1 year. I would recommend that you invest in this fund for 3 years or more, and please recognize that there will be credit rating problems. The NAV will drop by 3%, 4% of whatever, vertically down. But because the modified duration is low, and because it is investing in short-term bonds, the recovery will be relatively quicker than in other funds that invest in long-term bonds. And also Franklin, because this is a popular fund, because it's got 16,000 crores, almost 17,000 crores, that's pretty high. Because it's a popular mutual fund, Franklin may sell the bonds. In the past, the Franklin AMC themselves have bought it from the fund. So they may sell the bonds, then the loss will become permanent, then they will recover. They have done reasonably well. They have a very good track record in the debt space, but that doesn't mean you can escape risk. So please be careful. If I'm telling you this because a lot of people are interested. I don't, even after all these downgrades, many people are interested. So please be careful. I don't know how long this fund. I mean, I'm very surprised this fund has somehow managed to escape credit rating issues. I have recommended this fund with the due disclaimers about risk in my Plumbline list of recommended mutual funds. You can see the link in the description box. Please be careful. There are safer options. There is a Franklin India savings fund or a savings plus fund also, which is relatively better than this fund. I'm not saying it's risk free, but compared to this fund, that's relatively better. Of course, the return will also be lower. That's what I have to say about this. So please be careful. Use it for long-term goals if you are capable of handling the risk. Otherwise, stay away from this. Just the day before, I have written a post on banking and PSU funds. I had mentioned that banking and PSU funds need to only invest in 80% in banking and PSU bonds. The rest 20% they can invest anywhere. And I was informed by Sandy Shah that UTI banking and PSU fund fell by 6% because they were holding almost that much of a bond, highway bond. I forgot, Shillong Highway, I think. Some bond which is neither a banking bond or a PSU bond, but they held that bond, and now the UTI banking and PSU fund has to suffer that loss. So please be careful in the debt fund space. If you are worried, stick to liquid funds or overnight funds. Even in liquid funds, there can be problems. Quantum Liquid is a well-known fund which will avoid credit risk. You can choose that, or stick to RDs and FDs. No problem. You have to pay a little more tax, but that's the price you have to pay for peaceful sleep. So as far as this fund is concerned, that is all that you can do in terms of a debt fund review. You have to mentally prepare yourself. Somehow it has escaped, but I don't think it will for long. So that's what I wanted to say in this video. If you have any questions about this fund or any other aspects of debt mutual fund investing, I love debt mutual funds. please leave them below. So comment. I'll